My books, my books. Hey everyone, Curtis Ray here. It is a beautiful day in Gilbert, Arizona, December 2nd, about 4 p.m. Eastern, 2 p.m. my time. And we are feeling good. Just got my hair cut, feeling snazzy, and we are going to answer a bunch of awesome things about compound interest, money, retirement planning, your 401ks, your IRAs, everything you want to know, all things compound interest, all things money. Send me your questions. We're also going to do some comparisons, not really comparison anymore, but those how you build the best retirement plan and how you make sure that you are on the path to success. Albert Einstein is credited for calling compound interest the most powerful force in the universe, the eighth wonder of the world. He who understands it earns it. She who understands it earns it. If you're willing to take the time right now to make your financial education and your financial desires to merge together, that is how you produce the best future possible. So I'm here for you. I'm here to give you all my knowledge, all my education, everything that you need. We're going to do it right now. So we already got one question. Let's put him down right here.
Keener from YouTube. He says, do you have advice for a 45-year-old with only $11,000 in retirement and employment isn't secure, subject to probably being laid off?
So the most important decision you can make right now is get money making money for you. So you have $11,000, your employment's kind of wishy-washy, still start a compound interest account, because a good compound interest account takes about 15 years to really start maturing crazy. And so if you could start right now by 60, 65, you're going to have $500,000 inside this account, maybe even more, but you got to start right now. First rule of money, pay yourself first. Every single time you make money, part of it goes to your future self. If you can make that decision, you'll be okay. Reach out to an MPI certified advisor. He can work with you, build your plan. He, we got a bunch of advisors across the country. But go to www.calendly.com/mympi. You're going to see it pop up on the screen pretty soon. That is how you schedule one-on-one, right there.
Some 419 from TikTok asked, are you able to get an MPI if you're 24 years old?
Absolutely. If you're breathing, you can get an MPI plan. Typically, the age where MPI doesn't give you as much value as normal is around 60, 62 years old is kind of where, oh, okay, we got to work on this a little bit. But if you're under the age of 60, MPI is awesome. The sooner the better. The other day, a financial advisor was arguing with me because I made a TikTok video that said if you're 18 years old, the most important decision you can make right now is start a compound interest account. It will bring you millions and millions and millions of dollars of value to your future self. He argued with me, why would an 18-year-old ever need a compound interest account? They got plenty of time. No, they don't. The number one aspect in compound interest and the magic of compound interest, the phenomenon of compound interest, is because of time. And time is the one asset that once you lose it, you can never get it back.
James Ford from YouTube says, I've heard you say something about MPI 2.0. What will it be like and when will it be available? My wife and I have health problems, but are interested in knowing more about it.
Okay, so MPI 2.0 is a plan that I've designed and developed. Everything's always evolving. The one thing about going with me is I never say no to anything good. People ask me, Curtis, what's your superpower? And I go, I don't ever say no to anything good. If it's good, I want it. So people come to me and say, well, Curtis, my financial plan has this in it. Huh, I've never thought of that. I'm going to add it to MPI. So over the last year, 2, 3, 4, 5 years, it's been evolving and evolving and evolving. And I came up with a way to take our income from that 12 to 15% on average up to 15 to 20%. And so that is something that's in compliance right now. It has no effect on you. It's going to be an upgrade or an add-on to your current MPI plan. So you still want to start an MPI plan right now so you get it as big as possible. So when MPI 2.0 comes out, you're even more accelerated. You never want to delay secure compounding. And when MPI 2.0 comes out, which I'm hoping is in the next 6 to 12 months, then you're already rocking and rolling.
Asthma Unlimited from TikTok asked, I have a history of thyroid cancer and it's stable. Any chance that I can start my MPI? I'm 40 years old.
Little personal thing about me, my wife actually had thyroid cancer. She had her thyroid taken out. She just got recently approved for her MPI Secure Compound Interest account after 7 years of being cancer-free. So there are things that we do. We fight for you. We go through underwriting. We negotiate with the insurance companies. But history of cancer, those type of things, there are some things we've got to work on. So reach out to an MPI certified advisor. We can build your plan. We can go through underwriting. We can get what they're requiring and do our very best to get you approved. If you can't get approved, then we'll go to a spouse. If you don't have a spouse, maybe you have kids. There's always someone that we're going to use, and maybe even as a surrogate, to make sure that you get a secure compound interest account.
User 7783 asks, what advice do you have for a 46-year-old who hasn't started a retirement plan?
Start right now. It's always the answer. So how do I end all my videos? Always be compounding. The moment you make the decision in your life that you are going to become a compounder, it's a lifestyle. It's not even a decision. It's a lifestyle. That you're going to start making decisions that compound or naturally grow on themselves. That is how you become wealthy. That is how you become happy. That is how you become healthy. So start right now. You have plenty of time. Obviously, it would have been better at 25 years old, but you're 46. You've got a solid 19 years before you hit, normal retirement age. We've got to get aggressive right now. You don't have a lot of time to let the compounding effects really mature. So go to calendly.com/MyMPI. Schedule one-on-one with an MPI certified advisor, and they are going to help you build this plan and build your best future. So right here you see it, calendly.com/MyMPI, a one-on-one, no obligation with an MPI certified advisor. There's hundreds of them across the country, a little over 100 of them across the country, and they will help you build your best future.
Sunray from TikTok asks, can you speak on what is the best thing to do with a rollover 401k with a previous job? Should I let it ROI?
Okay, so an existing 401k you can't touch because that's with your employer, but an old 401k you have a few options. One, you could surrender it and pay a 10% penalty in your taxes. A lot of people do that because they find other places to invest their money that is much better than a 401k. Unfortunately, 401ks, even in index funds and mutual funds, are amateur at best. Amateur at best. So some people make the mathematical decision to surrender a 401k, pay the penalty, and then go invest it somewhere else. That's your decision. Other people take your existing 401k, roll it over into your current 401k, your old 401k can roll over to your existing 401k. That is good, but like I said, you're going right back into an amateur type account. And then some people pull it out to do whatever they want with it. But my job is to teach you how compound interest works, tell you how the most secure place you can do it. Right now, until December 31st, you actually could have access up to $100,000 in any 401k. Current, existing, old, whatever, whichever one, without penalties. You still have to pay the tax on it, and then you can go do with it whatever you want, live your best life, find other things that you want to use that money for. But yeah, till December 31st, the CARES Act will allow up to a $100,000 withdrawal, penalty free.
Okay, Vince Spires asked, what if I have $30,000 in debt?
Pay yourself first, start getting money compounding. I'm doing a video tomorrow or maybe the next day on 2 scenarios. Go all in on pay off your debt, and then when your debt's paid off, start compounding, or go all in on compounding for 3 to 5 years, then pay off your debt and then go back to compounding. And guess what? Compounding right now is the most important decision you could possibly make. Pay your minimums on your debt. And I know that sounds weird, but this is a mathematical game. You're being told so often on emotional games, Dave Ramsey and the rest of them like to say, make emotional decisions, and finance is an emotional game. No, it's not. The reason why most people don't have a lot of money and don't end up with a good retirement is because their whole freaking life they made emotional decisions. The moment you start making mathematical decisions, compounding decisions, that is truly the 8th wonder of the world, the most powerful force in the universe. So go all in on compounding. Every ounce of money that you possibly have, every dollar possible that is outside your obligations, that means your debt, like the minimums you got to pay, your mortgage, your electricity, every dollar possible, go all in on compounding for the next 3 to 5 years. Then you can go back and do everything else. If you do that, you will also end up with millions of dollars.
I have a comparison. Well, we'll need the calculator. We have Scott P. from YouTube. He says, I've been listening to your first book. I'm 49 years old. I currently have $70,000 in IRAs and 401ks, and I'm scared as hell. I'm ready to start paying myself first. How is the death benefit calculated? But I also want to give him some examples if you show him that, please.
Okay, let's just say you're saving $500 a month. So I'm going to do this example. Name is Scott?
Yes.
So Scott, this is so awesome that you reached out. This is a very important decision you need to make, and I don't take it lightly. So I want to educate you first. You're listening to my books. Real quick, Manny, if you can put on the screen, if you want a copy of both my books, I am giving my books away for free. Everyone Ends Up Poor, Lost Science of Compound Interest, audio and PDF. Is 100% free of charge, no obligation to anyone who wants to actually take their life next level. Nothing I ever do, all my education and knowledge will always be provided at no cost to you. But both these are available at mympi.com/book. The audio and PDF are free downloads there. Go there right now, mympi.com/books, and you can get them. So Scott, you've been reading my book. You're understanding that a lot of things about this system are broken. 401ks, IRAs were never designed to produce retirement income. A lot of people think that's weird, that these retirement plans were never designed with the focus of retirement income. How backwards is that? But you have $70,000 you want to start right now. So let's look at it. 49 years old, retire by 65, you have $70,000 of money. Let's just hypothetically say you could save $500 a month right now. By 65, that's only 16 years from now, you can have a tax-free retirement income of around $51,000 a year. Add Social Security to that, another $25,000, and you're between $75,000 and $80,000 a year in a very quick manner. If you do the same amount of money inside of a 401k, it'd be more around the $15,000 to $20,000 mark. So we're tremendously increasing it. But more important, not more importantly, but also add on, is you'll have a life insurance contract worth around $860,000. That is the lowest amount of life insurance required by law by the IRS for this amount of contribution into it. And so if you were to die, your family is going to receive $861,000, give or take, plus all the cash value you have in your plan. An MPI plan is dual. Your beneficiaries will get all of your cash value plus your life insurance, both of them combined. So meet up with an MPI certified advisor today. Today, go schedule it right now to build your MPI account, because it will bring you more value than any other retirement plan that is mainstream in the market right now.
User 5772, he goes, I'm 18 years old. I would like to start my MPI account, but I can only afford $200 a month.
That's so awesome. You're 18 years old and you want to start right now. So you are so far advanced above your friends and most everyone else. Check this out. One of the amazing things about MPI is we do not judge you for your income levels. This is one beef I have with the financial sector. If you don't have $50,000 up front, they don't even want to talk to you. You're not worth their time, because they get a percent of your account value. So if you're barely putting anything in, they don't make any money, so you're not worth their time. Now, everyone is available to come to MPI. You will get superior results, you will get life insurance, you'll get security, and you'll get the best retirement income. Because look at this, 18 years old, 65, you don't have a lump sum, but you can do $200 a month. Check how crazy that is. Oops, I don't want to do that. There it is. By 65 years old, your contribution of only $112,000, you only gave the compound account $112,000 total over that whole time frame. And look what the value is, up to $1.5 million. Compound interest. Einstein called this thing the most powerful force in the universe, eighth wonder of the world. Why? Because it can outwork you. It can produce more value to you than you can produce for you. Let me say that again. Compound interest can produce more value to you than all your work combined. You put in $112,000, it made you $1.4 million. But that's not even the good part. The good part is it produced your retirement income of up to $134,000 a year every year for the rest of your life, let's say from 65 to 90, which is a grand total of up to $3.3 million of retirement income, tax-free. So start right now, $200 a month is enough. Get rocking and rolling, and you will look back when you're 50s and 60s saying, holy crap, it actually worked. Of course, because compound interest is perfect. Our job is to get as close to compound interest as possible, and the MPI system is the closest thing to actual compound interest there is.
Dalin Pugh from LinkedIn, he says, this is interesting. I'll stick to my current plan, but so if the 401k were not meant for retirement, what were they meant for? Why does Congress sign off on the benefits of it?
because they get to tax the crap out of you later on. So 401k and IRA produces up to 5 times more taxable taxes, I guess it'd be, taxable income than a traditional Roth or something like that. It's sad that you say you're going to stick with your normal plan, because I need to explain something that is going to change your life. And that is understanding that they were never designed to produce income. They're not possible, and this is why. Let me go here. Where are you? Here. If you don't take the time to learn why a 401k IRA cannot and will never produce you good retirement income, you will look back at 65 years old and be like, holy crap, I listened and I didn't listen. I heard what he was saying, I never listened. Because they're designed backwards. This is why. A traditional 401k and IRA were designed on account value, how to build a nest egg. They never address how to distribute a nest egg, which is your retirement income. So you'll hear things like no risk, no reward, index funds and mutual funds make 8 to 10% rate of return. I'm making lots of money. You've got time, no risk, you got time to rebound if the market crashes. So what happens is in the early days, you are sprinting. You're making around 10% rate of return. You're feeling really good. Your financial advisor is telling you, hey, don't worry about it. We're making lots of money. And something terrible happens around 50 years old. Your portfolio begins to slow down. You start taking some of your stocks and start converting them to bonds. Then you hit 55, you do it again. You hit 60, you do it again. And by the time you get to retirement age, your account is walking. It is only producing around 4% interest. However fast you are producing interest in retirement, that is what's considered your safe withdrawal income. So if your account's producing 4%, you can take out 4%, 2%, 2%, 6. But in order to be secure, it's about a 4% safe withdrawal rate. That means you can have $1 million in your account, which only around 1.6% of the population ever achieve that. And you're going to spend around $40,000 of taxable income, which is about $35,000 net. Did you know that? That it slows down and doesn't produce income. MPI does it reverse. We start off slower because security is the cornerstone of secure compounding. It's the cornerstone of all compounding. But then we accelerate our rate of return. Compounding accelerates how much interest we can make. We speed up over time, and we end up retiring between 10 and 15% safe withdrawal income. That same $1 million can produce $100,000 to $150,000 of tax-free retirement income. Sprint, run, jog, walk is where you are today. You will inevitably end up frustrated and disappointed. It's called downsizing. If you want to take the time to learn how this works, you got to understand how compounding actually works.
Jason Carlock from YouTube, he says, I'd like to understand the fees associated with the program a little more. I understand that they are decreasing over time. However, the fees are the fees a percentage or a fixed amount per month/year?
They are a fixed amount, and that is the best part. Not a fixed meaning we know what they're going to be before it happens. They have nothing to do with your account value. You could have $1 billion inside your account and your fees don't change. So let me show you fees real quick. Where is my graphic here? There it is. Also, very important thing to learn about fees. Increasing fees, which are called compounding fees, decreasing fees, which are decreasing, obviously, right? So why most people don't get an MPI plan because of fees is because they're way more expensive in the first year. So this is a sophisticated plan. It has features and benefits that you need to, you want me to blow it up?
A little smaller.
Oh, smaller.
Just a little. There you go.
Okay. Okay, back to business. So the MPI account is a plan. You build it. There are fees associated with building this plan. It's like a Ferrari. It drives way faster, but you had to buy it. But so if you were in a normal financial advisor, oops. Okay. Okay. A normal financial advisor is going to charge you about 1% of your account value. That is near criminal. Yeah, you heard that correctly. AUM, assets under management, is what they call it, where they charge you a percent of your account value. So as your account compounds, they charge you a compounding fee. In the beginning, if you were to put in $10,000 inside your IRA that your financial advisor is managing, he would charge you around $110. Then as you keep putting money in, it's compounding. By year 10, about $1,800. By year 20, $5,800. By year 30, about $14,000. By year 40, around $25,000. And it gets bigger and bigger. And then he does you a solid and he discounts it in retirement to 0.5% instead of 1%. So it basically maintains $12,000 every year for the rest of your life. Do you know how much that is over the course of your life? Around $612,000 taken from your compound interest account. MPI is built opposite, is a decreasing fee. Build it, it's going to cost to build it, and then the fees decrease as time goes on. $998 in the first year. That does suck, but there's no way around it. I get it. It's just part of the system. I don't hide anything. By year 10, you're only $531 a year. Regardless of how much money you have in your account, $530 a year. Then $414 a year. You could have $1 million in this account, $414. But most importantly, when you hit retirement, regardless of the age that you hit retirement on, $60 a year for the rest of your life. Even if you retire at 40 years old or 50 or 60 or whatever age, $60 a year for the rest of your life. For a grand total estimated in this scenario of $21,565 for 65 years of management, not only producing security, superior income, life insurance, all of the above, a $590,000 difference between an MPI account and a 1% financial advisor. You're going to say, what about a low-cost index fund, right? That's got to be lower, right? Nope. In this exact same scenario, a low-cost index fund at Vanguard would be $65,000 of total fees. MPI is 1/3 a low-cost index fund at Vanguard in total lifetime fees.
GMFM from TikTok asks, is there a minimum down payment to start?
There are no minimums except for, let me explain. I said no minimums, but there is actually a minimum. If you take your age, times it by 100, that is the commitment we're asking for inside of the MPI Secure Compound Interest Account per year. So if you are 20 years old, oops, that looks terrible. 20 years old, your minimum would be around $2,000 per year, $160 a month. If you are 40 years old, that would be $4,000. Would be the minimum commitment we're looking per year. That can be divided between monthly, biannually, quarterly, annually, whatever you want. But yeah, 100 times your age is the amount we're looking for as a commitment to get the full benefits of a compound interest account.
User 447 asked from TikTok asked, I am 50 years old. I'm currently being able to put $700 a month into my account. What would it look like if I want to retire by the age of 63?
63, $700 a month. Does he have a down payment?
Not that I know of.
Not a lot of time, so I think we're gonna have to give it more time than that. It's still gonna be way better than a 401k or IRA, but it's, so right there. So your total contribution was $109,000. So the problem is that you're either gonna have a little amount of money or a lot of time. Those two things produce awesome results, or a lot of money, little time. In this scenario, we have a little time and a little money, so we'll see what the results are. $109,000 goes in the system by 63, $21,000 of tax-free retirement income, plus Social Security on top of that's another 15 to 20, so you'll be around $40,000. Maybe that's enough for you, maybe not. If you give it a little bit more time, it'll be a little bit better. But look at that. More importantly, this $21,000 will produce roughly $600,000 of tax-free retirement income. So you did put away 100 grand and it gave you back around $600,000 of income. If you gave this more time, let's go here and say 68. Look how much dramatic difference it was. 21,000 to 39,000. Now add Social Security that, you're in the $60,000 range for retirement, and now you're living pretty good. So you might need to give it a little bit more time at $700 a month, but go to www.calendly.com/MyMPI, schedule one-on-one with an MPI certified advisor. If you have a lump sum will do dramatic effects to this. Let's just say hypothetically real quick, man, if you want to go back to that, Let's just say you had money saved up in some other investment and you could put in a $50,000 lump sum up front. Look at how much difference that went. Went from 38 to 63,000 every year for the rest of your life. So let's do lump sums as much as possible monthly, and you'll get the best income.
William Thompson from YouTube asks, is this annual retirement calculation adjusted for inflation?
It's not, it adjusts for inflation, meaning you start here and it will increase 2.5% per year on average every year from that point on. But the actual calculations are built just straight. You put in money. That's why it's so important to pay a percent of your income to your retirement plan. We put right here $700 a month, but it shouldn't be $700 a month. It should be $700 a month plus inflation also. If you contribute with inflation, then this will be inflation adjusted. If you just stick to non-inflation adjusted contributions, then that is actually your amount non-inflation adjusted. So for example, if you're putting away $1,000 a month year one and inflation increases, the next year you should put in $1,030, increase it 3% per year, things like that, 2.5%, 3%. So as long as you're paying a percent of your income to your compound interest account, as you get paid more due to inflation, you're putting in more, and then your income will increase according to inflation.
G. Narsing from TikTok asked, can the secure leverage interest rate increase, or will it always be between 4 and 6%?
It is contractually guaranteed to never go past 6%. So that is a contractual guarantee. Right now it's 4% because interest rates are so low. But yes, it is contractual guarantee, never to exceed 6%. We've run all our models at 6%. MPI still provides superior advantage even at the 6% rate.
Boots Rockaway from TikTok says, I'm 52. I have $15,000 to start and I can put away $12,000 a year.
52. How much does he have down payment? 15?
15,000.
15,000, and he can put away $12,000 a year. I'm gonna put $1,000 a month just to keep it easy. And let's say, so by 65. So by 65 in 13 years, it will produce roughly a $35,000 tax-free retirement income plus Social Security. If you give it a little bit more time, let's run that out till 70 because we don't have a lot of time. But look what happens if you run it out till 70. $63,000 a year of tax-free retirement income. So in 18 years, putting away that $15,000 plus $1,000 a month, we'll get roughly $63,000 of income. But look how cool that is. A lifetime retirement from 70 to 90, $1.2 million of tax-free retirement income on a total contribution of $231,000. Just shows you how powerful compound interest is.
T. Brooks from TikTok says, the question that I have is this whole life plan or term life?
Neither. Whole life sucks. Term life is basically throwing away your money because only about 1.5% of all term life policies ever pay out. So there's a 98% chance, give or take, that you are throwing your money away to term. Whole life also sucks. So let's go over here real quick. Oops. Let me clear this screen up real quick and pull up an additional thing. Whole life versus MPI. I think it's in here. Okay. Is that about right? Okay. Whole life is a system where you put your money into a life insurance contract and then they guarantee you some type of a dividend. It typically ranges between 3 and 5%, and that's as much as you're ever going to get. 3 to 5% is not enough to produce good results in your lifetime. It may be 75 years, you can start getting pretty good money inside of a whole life. They are complete garbage as a retirement plan. MPI is a life insurance contract that is kind of similar in the fact that you put your money in a life insurance contract. It's going to produce a dividend-like growth for you between 3 and 5%, but this is where we go different. We believe in the stock market. The stock market is good. It makes lots of money. It's just not secure. So what we do is we take that 3 to 5% dividend-like growth and we go buy an S&P 500 call option. So right here, 3 to 5% dividend-like growth, dividend-like growth, and we go buy an S&P 500 call option. Why did we do it that way? we're only going to take the 3 to 5%. If we only take the 3 to 5%, even if it loses, we didn't lose any money in the account. If it wins, we win big. So it's this yin and yang, growth and security combined. When you do that, it accelerates the rate of return. On top of that, we have a relock feature, retirement equity line of credit, that accelerates yet again. And we can end up with about a 15%, give or take, total growth as it matures with time. Somewhere between 10 and 15%, depending on how much time you give. What does that do differently? This is the result. Imagine you're putting in $10,000 a year into a whole life, an infinite banking concept, a bank on yourself, that type of cell system, or an MPI system. After 30 years, both systems put in $300,000. A whole life will have around $600,000, MPI around $1.5 million. But more importantly, the income, up to $150,000, I just estimated at 10%, or $30,000. 5 times more retirement income than the garbage that they call infinite banking.
Quick answers, okay?
Quick answer. Okay, we're going to rapid fire.
All right. Bryce Newth, are there any tax advantages of contributing to this into an S Corp?
I'm not too familiar with that. A lot of people say they may or may not put in that, but it is a post-tax system, so you don't want the tax advantages because you want tax-free retirement income long-term.
G. Narsing from TikTok says, can the IRS change the code of 7702A? What would happen?
They could change the code. It used to be 7702. They changed it in 1987, I believe, and now it's 7702A. But if you are in the system already, you'll be grandfathered into that, and then the new plans moving forward will be according to the new code.
Janel from TikTok's asked, on track to retire in 4 years at 59 and a half, which is right now. Should I continue to contribute more into my 401k?
No, we should talk about starting an MPI account because your 401k wasn't designed for income. You need a place to take that 401k and roll it over to when you're finally in retirement. MPI is your best option. Meet up with an MPI certified advisor. Manny, put up the invitation on calendly.com/mympi.
Jigma65 from Instagram asked, can you roll over your 401k?
No, you can't, because 401ks are called qualified money deferred taxes. We want to pay tax on it now, like a Roth IRA, so you're 100% tax-free in the future. There are some options for you. Reach out to an MPI certified advisor at calendly.com/mympi. But you do want to stop contributing your 401k unless it has some just killer match program, because MPI is far superior.
So user 4346 says, I'm 33. If I could put $1,000 down and put a minimum of you recommended a month, how can I retire at the age of 55?
How old is he?
33.
33. If you want to retire by 55, that's 22 years. If you can save as little as $15,000 a year, actually your $30,000 down payment with $1,000 a month, you could be retired on 6 figures in roughly by 55 years old. You put more than that, retire at 50. You want to put more than that, retire at 45.
Bryce Newth comes back from Instagram, asks, where can I find an MPI advisor near me?
Okay, go to calendly.com/mympi. I believe there's a notes section that you can put that you're specifically looking for someone in your area, or send me a direct message. If you send me a direct message on Instagram, TikTok, anywhere, where you live with your name and phone number and email address, I will find someone as close to you. We have about 100, so we're not in every state or in every city, but I'll find someone who can help you.
Chef Hala from TikTok says, let's say the stock market crashes.
First of all, I ain't no holla back girl. I don't roll that way.
Hala. How would this affect my account if the stock market crashed?
That's the one thing that amazes me about MPI. We have a thing called a 0% floor. We do not lose because the stock market plummets. That is the most important thing you can learn about compound interest. Is secure compound interest is way better than risk-based compound interest of the stock market.
Can you comment on why Dave Ramsey suggests that you should never mix your life insurance with your retirement?
Because he has no brain. I'm sorry, I shouldn't have said that. Because he uses emotional. He doesn't understand how math works. That guy, unfortunately, is not a mathematician and knows very little about retirement planning. The real saying is this: never mix your investments with your retirement plan. Investing and retirement planning are complete polar opposites. One is to protect your future, one is to make the most amount of money. They work together, but they're opposites. You make money to fund a retirement plan. That is how it works. Never mix your investments with your retirement plan. A life insurance contract is a superior retirement plan than any stock-based system, mutual fund, ETF, indexed fund.
Cassius Holmes, is this an IUL?
It is kind of like an IUL. It's the IUL 2.0. Indexed Universal Life is pretty good. It has some tremendous flaws to it. MPI addressed those flaws, enhanced them, and now an MPI account can produce up to 3 times more retirement income than a traditional indexed Universal Life.
G Narsing 78 from TikTok says, if the yearly return is 0 that year, aren't we losing because of the loan interest that we have to pay 4 to 6% on?
Not exactly, because the insurance companies defer all your interest payments all the way to the day you die. They settle up the interest on the day you die. So some years, yeah, there's a 4% cost. All they do is defer that interest till the next year and the next year and the next year. You even out at about a positive 3% spread inside this loan feature. Your money's making around 7%, and that's how we collectively make double digits, even, as an average with the good years and the bad years. But yeah, you don't lose money in the account. You just defer the interest until you die.
Kruji from TikTok says, what about the benefit? If I die at 60, putting in money after 20 years, does it go to my spouse?
Yeah, it's called a death benefit. A death benefit inside of MPI is your cash value, all the money inside your compound interest account, plus your life insurance. All of that will combine and pay to your beneficiaries tax-free.
Sorry.
I'm too rapid fire.
You are, that's good. No. Zach Morgan 77, what is the catch of MPI? What is the bad stuff about it?
There are 2 really bad things about MPI. One, not everyone qualifies. It breaks my heart that about 10% of the people who are applying right now do not get qualified because it is a health exam. It is a life insurance contract, and it's really hard when I get someone who believes in what we're doing and then I have to tell them no. We then go try to insure their spouse or their kids, and we have other options too. The second thing is it takes time. There is no get rich quick. Compound interest is perfect. What MPI is trying to do is get as close to compound interest as possible. So we're eliminating all these negative things inside of it to get as close to compound interest. If you give it time, it will work. It works every single time because it's a math equation, and math equations never, ever go bad. The third thing, actually, I don't work in New York. I get hundreds of people from New York contacting me every day, and I'm so sorry. I am working so diligently to find a New York solution. I just don't have it quite yet, but it is coming soon. So I will find ways to get inside New York, but right now I can't help anyone in New York.
Zach Langler from Facebook, he asks, so does the money then go from the stock market and goes right back into your account?
Yes, it's in an S&P 500 one-year call option. When that call option expires, then it goes into your account. Whatever growth you made goes right into your account. Now you have a bigger account. That bigger account value now makes the 3 to 5% dividend-like growth, and we buy a bigger call option. So that's how we compound it and never actually lose. In 2008, your 3 to 5% dividend went into the call option completely imploded. Everyone else lost 40% or up to 100% inside the call option. We broke even. 2009, we start right back to where we were because that dividend-like growth happens every single year.
Red Hook from TikTok says, do you recommend buying any precious metals as a safe haven against the Fed, inflation, or financial reset?
I don't, and the reason being is gold and silver actually is tremendously volatile. So inside the risk-return pyramid, you can Google risk-return pyramid, gold and silver is actually at the top.
You should show them.
I don't know if I have it inside this section. Let me see. It might be in the additionals, it might not be. It is? Okay. Okay, so guys, what we're going to look at right now is called the risk-return pyramid. Oh, it's not on this one. How do I?
Additionals.
Okay. It's not in additionals, it's in this one. Okay. Okay, so this is called the risk-return pyramid, what you're looking at. I'm going to blow it up just a little bit. Okay, so if you look here, this is the degrees of volatility inside of compounding. So all these things here are some type of compounding where they'll grow on their growth on their growth. If you look right here, futures are at the top. Those are, things you're betting on the market, your different options, things like that are extremely volatile. Gold and silver is right here. Everyone tells you that's a safe haven. It's one of the most volatile things with inconsistencies and ups and downs there possibly is. Growth mutual funds right here, options, this is where we're playing right here. Options are right there. Growth mutual index funds, real estate is right there. Everyone thinks real estate's really secure. It's extremely high on the growth or on the risk return pyramid. But what is at the bottom of the risk pyramid? MPI. insurance-based investments. Why? Because for 110 years, they haven't lost money. They have a perfect track record. Even in the Great Depression, 2008 dot-com, insurance companies were profitable. That is why we build MPI inside of an insurance contract, because it's the only thing in the whole compounding system that is at the bottom of the risk pyramid, but has the growth of up here combined. It's a yin and yang feature, security and growth combined to produce the best result.
Lots of questions.
Okay, rapid fire.
All right, Alablaster 94. Is it better to invest 600,000 at once or 60,000 over a 10-year period?
At once. Compounding is about doubling of money. You put in 600,000, it will double in roughly 6 to 7 years and continue to double. If you do it 600,000 or 60,000 over 10 years, it does about half the results.
Scott P. from YouTube says, in your book you talk about 2 MPI accounts for married couples. What's the benefit of this having this strategy?
The benefit is if someone were to pass away, then you get to take that death benefit and roll it over into an already existing account. It is really hard for, I haven't done it yet, but I've been told it's difficult, that when a spouse dies and there's $1 million check, for me to go to your spouse and then convince them while they're really sad, depressed, emotionally distressed, that they need to start a secure compound interest account with that money when a bunch of people are talking to them. No. We want 2 dual accounts. They compound identically when you combine them together. We have a place to roll over the money if there were, unfortunately, death to happen.
Miguel Prado from Instagram says, flexibility of premium. Can the insurance company raise the premium when they see fit?
So there are 2 things that you just said that are actually slightly inaccurate. I'm gonna talk about that real quick. There are 2 things going on. There's a premium, and then there's a cost of insurance. This is how much you're paying. A very, very, very small percentage of this, somewhere between 2 and 3%. Of this money is going to your cost of insurance. It does increase every single year, but your compound account is increasing way faster. So the cost of insurance is such a small factor inside your compound account, it's almost not even noticeable.
Susan from TikTok says, I'm 45, have 2 life insurance term and a 437 and a retirement, not 401k. What amount can contribute a year?
You can put in as much money into MPI as you possibly can. Your limits are basically 1 year of your salary. So if you're making $50,000 a year, you can put in up to $50,000 a year. A life insurance contract will never allow you to commit to more than what you make. And so you're kind of limited on a 1 year salary.
Woods for Days says, I'm 53, would want to start a retirement portfolio putting $5,000 a year, but I want to retire by the time I'm 65.
And it doesn't work that way, unfortunately. You got to put in more than that. You got to get more aggressive. Unfortunately, you didn't start when you're 25. I want to help you, but you're going to have to put in more than $5,000 a year because that's only 13 years, 12 or 13 years. $60,000 just does not have enough power or time to produce these significant results. If you give it more time, it could. If you put in more money, it could. But compound interest is not magic. It's compounding. So we got to get more aggressive. At your age, you need to be putting in around $20,000 a year, maybe even 30. And if you do that, you can have a really awesome retirement in 12 years.
Bryce Dubos from YouTube asked, can you still draw compound interest on your money even after you start pulling it out during retirement? And is MPI available in Alabama?
MPI is available in all 50 states except for New York. New York is where I don't play. They've got some pretty crazy stuff going on over there. But you can always withdraw from your cash value inside your plan is liquid, so you can retire early and you can continue to put as much money into it till the day you die. The more money you put into compound account, the more income it's going to produce. So if you made money even in retirement, put it in your compound interest account so it's money making more money for you, and then withdraw whatever you need to live off of.
All right, Burl Wood, where do I find these type of investment accounts? Online?
Right here, calendly.com/mympi. Traditional banks and traditional financial advisors cannot offer a secure compound interest account. They offer stock-based compound interest accounts typically. And so they try to go for home runs. They try to go index funds, mutual funds, ETFs, things like that will inevitably underperform. You want a secure compound interest account, go to calendly.com/mympi. You see it right here on the screen. And that is how you build a secure compound interest account with an MPI certified advisor.
Hoondog56, why aren't other companies doing this?
There's about 100 different companies doing this. So, you have to be MPI certified in order to offer it. There's about 100 of them across the country that are currently offering this. I don't actually make plans. I am the one who educates. I'm the one who writes the books and does all these live events. But an MPI certified advisor is the one who's independent. They have their own businesses, their own financial practices across the country. Go to calendly.com/mympi. If you're on TikTok, you're going to see a ton of them talking about it. They're all opening up their TikToks and they're talking about how MPI can bring value. But yeah, there are a lot of people talking about it, a lot of companies who offer it.
G. Narsing from TikTok asked, in the years that we make more than 12%, who gets the extra money? The insurance company? Suncor?
No, it doesn't work that way. So remember, you're only taking 3 to 5% interest. And we're buying a call option. That call option is then making around 200% interest for you, which collectively is around 12%, 10 to 12% interest on all your money. So a very small amount of money is making a ton of money, and when you shrink it back down over all your money, it's about 10 to 12 to 15%. So you get 100% of what the call option makes you. It averages out between 10 and 15%.
Luke Peters 68, do you manage the investment accounts or does it act like an ETF?
Well, it is a plan, so it is built and there are no variables. Every single person inside of MPI has the exact same plan. That is what's awesome and why we don't charge management fees and the 1% criminal fee called AUM, assets under management, is because you are built in a plan that was designed to win. And it will continue to move forward. We don't make very many changes to it very often and very small variables inside of it. But yeah, it's managed by an A+ rated multi-billion-dollar life insurance company that does the call option purchase for you once a year.
Zach Morgan says, thank you for your response. In the event of an emergency, can I withdraw with no penalty?
Everything but the first year. The first year is set aside. The insurance companies spend a lot of time and money to set up these plans. They don't charge you for this, or they charge you very little for this. But they do put a restriction on that first year contribution called a surrender schedule. Meaning, if you cancel, they're going to charge you. It's an early cancellation penalty. After year one, all the money you put in and all the growth inside your plan is pretty much accessible to you. No penalties, no fees, no underwriting, no credit checks, no any of that stuff. It's available to you as emergency fund.
Blazer Rosier, I believe. You don't do this for funsies. How do you get paid?
So I built MPI. I am the architect of MPI. I have a contract and I have a partnership with the life insurance company. Life insurance companies make profit off of selling life insurance. I get part of that profit. We are a partnership, it's a profit share. So that's why I offer everything for free, all my time, all my efforts, my books, everything, because I don't need to manage money. My job is to educate you. Anyone who does go into MPI, I do get a profit share with the insurance company.
D. Wilson 30. I'm 52 years old. I have $1 million in my 401k. What should I be doing now?
You need to get that money in a secure compound interest account because that $1 million inside your 401k is only going to produce you around $40,000 of retirement income. You need to start an MPI compound account as quickly as possible because by the time you're 59 and a half and you're able to access your 401k, we need a place to start rolling over your 401k into a retirement plan. 401ks are not retirement plans. So please schedule a one-on-one with an MPI certified advisor at calendly.com/mympi. They're going to build you this platform that was designed for retirement income. Keep your 401k, keep doing what you're doing, start putting as much money into MPI so when you hit 59 and a half, we can start rolling that money into MPI, and that is how you're going to produce up to $150,000 of retirement income.
Zach Langer, is this Primerica the same type of plan?
Primerica, oh, they're the worst. So no, I have nothing to do with Primerica. They are a buy term, go invest in the stock market. They do double whammies. That is the two stupidest things you can do as a retirement plan. Buy term insurance, you're throwing that away most likely, and it expires. So when you actually need money for your beneficiary, let's just say you die at 70, you're leaving your spouse with nothing because your term policy expired. And then they go invest in the stock market, which was never designed to produce retirement income. Primerica's the worst retirement planners on the whole freaking planet. They literally give you a double whammy. Buy term, invest the rest, stupid idea.
Last question. Mando Furio. Can the person pay a different amount on the premiums? Let's start off at $500 monthly and then possibly build to $1,000 a month?
Yeah, so basically we do 1 year commitments. You're gonna set up a 1 year commitment. I'm gonna do X for 1 year. I need you to commit to that year. Then at your anniversary date, we can then get together and say, hey, you wanna do more? Well, what's your situation? We can adjust it once a year moving forward. Always commit to 1 year. After 2 years of fully funding a plan, it becomes extremely flexible on how much you do. Always do as much as you can so that your compound account's getting as much money into it, and then it compounds the best. So guys, one more time, my 2 books, Everyone Ends Up Poor, Lost Science of Compound Interest. Go to this link below, mympi.com/book. They're available at no cost, no obligation. You're gonna get both books, audio and PDFs are available to you. All you gotta do is go to mympi.com/books and you'll get them. The power of compound interest is like nothing you'll ever see. Once you see it, you can't unsee it. That's why I'm so extreme. I know you guys probably think I'm really extreme, but once you see how secure compounding works, you cannot unsee it. That's the blessing I want to give you guys, that your life will change forever. Einstein was not exaggerating when he called this the most powerful force in the universe, the 8th wonder of the world. Today is your day that you get better. You deserve better. Be better. I'm Curtis Ray. Always be compounding.